You want to invest in the stock market. And then you look at Tesla, it's selling for $200 and something dollars. You look at Walmart, selling for $30 something dollars. Amazon, $30 something dollars. You look at Palantir and all of those stocks, and they all have all these prices ranging from anywhere from $1 to $200, $500. And you're wondering which of these stocks is a good investment. Because let's face it, even those stocks are a very powerful vehicle for passive investments. Not all stocks are created equal. Some stocks are expensive. When you buy them, it becomes difficult to recoup your investment. While some stocks, when you buy them at the right time, you can make a lot of money from them. We all know that people like Warren Buffett, who is a value investor, became one of the top 10 richest people in the world by investing in stocks. That's all he does. So it's very clear that investing in the stock market is one way to create generational and long-lasting wealth. And the best part, it is passive. You don't have to work for that company. You become a part owner of that company. So if you've been wondering which of these stocks to invest, then you're in the right place. Because in today's class, you will master one of the key metrics for investing in the stock market, which is the PE ratio. I've been investing in stocks for the past 20 years. Everything I've learned about PE ratio in the past 20 years, within the next few minutes, you will master this principle. So in today's class, you will learn how to calculate the PE ratio. You will also learn how to calculate earnings per share, how to use PE ratio to analyze the value of a company, how to invest like Warren Buffett if you are a value investor, or like Cathie if you are a growth investor. Then we're going to see some real-world examples like Palantir technologies. We're also going to use a case study of Tesla versus Ford to understand how the market evaluates the stock price. Finally, if you stick with me to the end of this class, you will learn about other important metrics that will help you to be an intelligent investor. So if this sounds like something you are interested in and you actually want to build wealth in the stock market, then let's dive right into this class. Before we go to the PE ratio, if you don't know what a stock is, then watch this video over here. It's a fictional story of a young man called Marco and how he was able to expand his company by selling shares. That will give you a very good idea of what a stock is. But in summary, buying a company share means that you are buying a fraction of that company. First, as a shareholder, you are a part owner of a company. A business owner who needs money to expand his or her business can decide to sell stocks in the company. Essentially, what the business owner is doing is selling fractions of his or her business to interested investors who now become part owners of that business. So when you buy a share of that business, you become a part owner of that business. Assume that a business founder wants to sell shares in the company, right? Then he breaks up the company into 100 units. Each of these units is called a share. And the company founder keeps 20 units for himself or herself. That means that the founder now owns only 20% of that company. If you buy one of that unit, it means you own 1% of that company. In the real world, you don't break company into just 100 units. The minimum you can do is about 1 million shares. Most companies offer 100 million shares, 500 million shares or more. But the mathematics is still the same. So if, for instance, a company offers 100 million shares, right? And the owner or owners of that company keeps 20 million shares for himself, that means the owner owns 20% of that company. And then if you manage to buy 1 million shares out of that 100 million shares, right? Then you also own 1% of that company. Now that you want to buy a share of a company, you want to be an investor. The question is, how do you value the price of each share of the company? In today's class, we're going to learn about one of the key metrics for evaluating a company to know whether it's undervalued, fair price, or overvalued. And that metric is the PE ratio. PE ratio stands for price to earnings ratio. It is the stock price of a company divided by the earnings per share of that company. It measures how much investors pay for $1 of a company's earning. And so I'm going to show you very quickly how we calculate the earnings per share and then how we use it to calculate the PE ratio of that company. So here is a case study with FedEx. Now, as at the time of this recording, FedEx stock price is $242.62 per unit of share, and their earnings per share is $16.85. Thus, their PE ratio is that stock price, which is 242.62, divided by the earning per share, which is 16.85. So that gives us a PE ratio of 14.4x. Now that means that investors pay $14.4 for every $1 of FedEx earnings. And let's do some calculations so you even understand it much better. All right, let's assume that a fictional company has 1,000 shares. Of course, you know that, as I mentioned, companies have 100 million shares and above. We're just using 1,000 shares to make it very easy to understand. So let's assume the whole share the company has is just 1,000 shares. Now, in the past 12 months, this company had a net income of $250,000. Okay, the net income is the profit the company has made minus all their expenses, salaries, and all that. So the net income in the past 12 months was $250,000. So what is the earning per share? I think you can guess. So the earnings per share for this company is this net income, which is $250,000, okay, divided by the number of total shares the company offers, which is 1,000. Okay, so now our earning per share for this company is $250. Does it make sense? So this simply means that every single share in this company earns $250 in the past 12 months. Now, let's use this to calculate the PE ratio. So let's assume now that the company sells every single share in the company for $5,000, okay, for each single share. So this becomes the stock price. So what is the PE ratio for this company? Remember that the PE ratio is a stock price divided by the earning per share. So the PE ratio, of course, will now be this 5,000 divided by 250. Okay? So the PE is what? 20x. Because when you divide 250 by 5,000, you have 20x. Does it make sense? Now, one way of interpreting this result is that since I bought a single share of this company for $5,000 and I get $250 return on each share per year, that means it will take me 20 years to recoup my investments. Okay, because this year I have $250. Assuming I continue to have these $250 every year, in 20 years I'll recoup my investment. However, this is not the full story, but that's a simple way to understand it. Why I say it's not the full story is because most companies will not give you everything that the company earns in a year. For instance, this company, each single share earns $250, right? But the company will not pay you that $250. They may pay, let's say, 50% of it to you as an investor, and the rest of the money will be used to reinvest in that company. These are the things you decide. You also, as a part owner of the company, will help in deciding during your shareholders meeting, the annual shareholders meeting. Okay, you decide how much of this earning per share should be paid as dividends to investors and how much should be reinvested in the company. But what I say, it also gives a rough idea of how many years it will take for you to recoup your investment. Is that even the one that's invested in the company will go into improving the share price, because when the company grows, the share price also increases. So in any case, this $250 earning per share is the value that each share accrues to the owners every year, both in dividends and reinvested profits. I hope this is quite clear. Now you have an idea of how we calculate the earning per share and how we use it to calculate the PE ratio. We also have an idea of what a PE ratio is, like how much it returns to you. How do we actually interpret whether a company is overvalued or undervalued? Which PE ratio is good? Is 20 good? Is 10 good? Is 30 good? Okay, that's exactly what we're going to learn next with some real-world examples. So let's interpret the PE ratio. Generally, a PE ratio above 20 is said to be high, while a PE ratio below 15 is said to be low. But you don't just conclude like that. There are positives and there are negatives. Some companies have PA ratios as high as 90, 100 and above. We're going to see it shortly. So why do investors continue to buy shares that have a PA ratio of up to 100? Are they ready to stay alive for the next 100 years to recoup their investment? No, there's a reason why. On the positive side, a high PE ratio suggests that investors have a high growth expectation for that company. They believe this company will do well in the future, that what the company is earning currently does not reflect the potential of the company in future. Take, for example, a company that is in the cutting edge of AI may not be earning much profit right now, but investors may believe that this company will make a lot of profit in the next 10 years. So they may buy the stock even though the PE ratio of that stock may be 100 today. So PE ratio that is high usually shows premium pricing. The kind of investors that invest in this type of growth assets are known as growth investors. A typical example is Cathie of ARK Invest. Okay, she invests mostly in cutting-edge technology, AI, cryptocurrencies, things that she believes has a very high growth expectation in the future. Okay, but there are also negatives for companies with very high PE ratios. So before you invest, you must be aware of the negatives. The first important one is that it's possible that this company is highly overvalued. Because what stops a competitor from coming to the market in the next 5 years and dashing all your expectations? So it is high risk, but some smart investors will still go ahead, especially if the company has what we call a moat. That is, some special advantages like some patents or cornered some markets. Maybe they have a monopoly in some kind of government contract or stuff like that. This might give investors very high confidence that this company is going to do well in the future and no competitor will be able to overtake them. On the other side, low PE ratio, there are some positives, also some negatives. A low PE ratio may indicate a very mature company. For example, if you have a company like Coca-Cola, it's very mature. Coca-Cola, for instance, has already gone around the whole world. Unless we find another planet where people don't drink Coke, then they can expand further to that planet. But now they have actually saturated the entire world. So a company like that is known as a mature company. They still generate very good profits, but their PE ratio will be modest because people already know that there's something like a sudden expansion in the future. Is mature, they give you a very steady income, right? So these are companies that we call mature companies. Another thing is that companies with low PE ratio might be possibly undervalued. This kind of investment strategy is known as value investor. And a typical value investor that everyone knows is Warren Buffett. But then companies with low PE ratio also have some negatives. It may be that investors don't expect a lot of future growth in that company. And also it may mean that people don't have confidence in their future. Some of them, people think they may go bankrupt, or people think that newer competitors are coming up that will eat their lunch. Let's take a look at some companies that have very high PE ratio and some that have very low PE ratio. Here we have Palantir Technologies, and come over here, you see their PE ratio, 303. Why are people willing to pay for a company whose PE ratio is so high that it will take 300 years for them to recover their investments? It is because this a company that is focused on AI, software as a service. If you look at some of their customers, you see that they have very big customers like the US government. Take a look at their offerings: anti-money laundering, automotive and mobility, data protection, defense, ecosystem, energy, federal health, federal financial services, Palantir for builders, government financial management, health and life sciences, hospital operations, intelligence. Their software power some of the biggest companies in the world and also governments. And because of this, investors believe they have a wide moat and also they have big growth potential. That is where growth investors are willing to pay top dollar for the share of Palantir. Now, let's look at some company with very low PE. Look at General Motors over here. Look at the PE ratio, 6.24. Compare this to what we just saw, 300. This is just 6.24. That means I should be able to recoup my investment in just 6 years. So why wouldn't I invest in this one and go for Palantir? Again, because investors are valuing this based on the markets. Maybe there's a lot of debt profile. Maybe the confidence in the car industry. People don't believe that General Motors have a lot of potential in the future. So what is the methodology for evaluating the PE ratio? When you have this PE ratio, what are some of the things you must look at to know where you should buy or not? The first thing you should do is to compare the PE ratio of the company you want to buy with other peers in the industry. So, for example, you want to buy Tesla, which is a car company, compare it with other car companies so you know if the PE ratio is fair. Then the next thing you should do is to compare the PE ratio of that particular company with the overall average industry PE ratio. Again, for example, Tesla, there's a place where we can get the overall industry average for that particular industry. If it's something like Walmart, we look for the industry average of the retail sector. So compare the PE ratio of that particular company with the industry average. That should also give you an idea as to whether the price is fair, undervalued, or overvalued. So let's apply this methodology to some stock price. This is Tesla versus automotive industry and Ford. Tesla PE ratio at the time of this recording is 162. It has come down now to around 90. The industry average, the car industry, is around 12.6. And Ford has a PE ratio of 6.4. Tesla PE ratio is significantly higher than both the industry average and Ford, indicating that investors have high growth expectation for Tesla compared to its peers. While Ford's PE ratio is below industry average, suggesting that the market has more modest growth expectation for Ford. Now, if you actually study Tesla, which we are going to do in depth in a later video, you understand that they're not just selling cars. Elon Musk doesn't believe that Tesla is even a car company. He believes that it's a technology company. Their cars have driverless mode where people can just go, start the car, set their direction, and the car will drive into that place. Apart from the fact that it's electric. And then the future plans are just enormous. They intend to bring the humanoid robots. They intend to bring the driverless taxis. They're also involved in AI, involved in the Boring Company, and so many other initiatives, which other car companies are not doing. Most other car companies, especially traditional ones, are focused on ICE engines, which investors believe will go extinct. Now, you as an investor, you have to decide, do you have the stomach to take the risk? Will you buy Tesla? Will you buy Ford? Amazon versus the retail industry and Walmart. The PE ratio for Amazon is 38.6. The retail industry average is 22. Walmart, which is another retail company, the PE ratio is 38.87, very similar to Amazon. So if you want to buy a stock in the retail sector and you have Amazon and you have Walmart, you can actually choose any of them because you can see instantly that they have very similar PE ratio, which shows you that their value is comparable. Okay, so this is not something that will be very difficult to decide in this instance because the comparison gives you a very good idea of the fair value of this share price. Finally, I promise that if you stick with me to the end of the class, I also share some powerful metrics that will help you to be an intelligent investor. For example, most people ignore the debt profile of a company. A company may be posting much earning per share while ignoring their debts. So, if the debt is high, the PE ratio does not tell a full story. So, even though the PE ratio will give you a good idea of what is going on, you still have to consider some other metrics. So, the first one you have to consider is the debt to equity ratio. Next one is the price per earnings to growth ratio, and then the price to book ratio, and then the dividend yields. And finally, you have to do your fundamental analysis. This is very important, especially for those who are value investors. When we talk about fundamental analysis, we're talking about the management, the competence of the management, the market conditions, the competitive landscape, and the industry standards. Now, if you want to learn more about these important metrics, all you have to do right now is to subscribe to this channel, click on that notification bell so that when we have these upcoming classes, you also will be notified. If you have gained any value in this class and you are interested in learning more about investments, business, and especially personal finance, then subscribe to this channel and also hit that notification bell so when next I release a class like this, you will be notified. Thank you for watching and see you next time.